Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here is your starting lineup for the 3 in 10 podcast for Friday, October 3rd, recording at 1:30 Eastern Daylight Time. Our first topic, the government shutdown. Does it really matter for the economy or markets? Number 2, no non-farm payrolls today. How do we triangulate? Well, we dig into the ADP employment data, and we also dig into the ISM manufacturing and services surveys for the month of September as a way to triangulate and get to the bottom of how this labor market is developing. Number 3, twin bankruptcy filings. Tricolor and First Brands file for bankruptcy very close to each other in the month of September. We dug into this a little bit beneath the surface to figure out what's going on. Is there any problem in credit land? So starting with number 1, the government shutdown. History says that shutdowns don't matter, at least the last 3 going back to 2013, the ones that we studied. This time could be a little different depending on the duration of the shutdown. In our opinion, an extended shutdown could hit consumer confidence, could add to job losses, and add to uncertainty, which we've been battling all year. It could also refocus foreign investors on the massive U.S. debt and deficits, which don't appear to be changing anytime soon. In other words, the bond vigilantes could ride back to the OK corral, potentially pushing yields higher. Could also add pressure on the Fed to cut 50 basis points instead of 25 basis points at their October 29th meeting. Remember, the Fed will never say this, but cutting rates is a convenient release valve for all this political pressure and this fight for their independence. Democrats don't seem to have very much to lose here in this government shutdown fight. Trump has rolled over them all year long. They need a fight to show that they're opposing Trump, and the left wing of their party demands it. Democrats have decided that the ACA subsidies are the hill they want to fight and die on. We'll see how that works out for them. Markets may need to discipline Republican and Democrat politicians once again if this shutdown extends. In the end, we see the shutdown as bearish for the dollar because it refocuses foreign investors on debt and deficits, political polarization, and just frankly poor financial management out of the United States. We see it as bullish for gold, silver, and copper, which are real assets which hold their value and even increase in value when the dollar is weaker. Number 2, no non-farm payroll report today. Well, we're going to take what we have, which are private surveys, the ADP employment data and the ISMs. For now, that's all we've got to go on. But ADP was a pretty significant miss at minus 31,000 jobs compared to an estimate of 51,000 jobs being added. The prior month revision was pretty stark here, going from plus 54,000 to minus 3,000. So basis ADP, August and September showed job losses. And when we look back at the last 4 months, the ADP survey has showed job losses in 3 out of the last 4 months. The bottom line from us here is the labor market continues to cool. And the ISM employment components of those surveys also corroborated that fact, as both remained below 50 in contraction. We think this will reinforce the Fed's desire to keep cutting rates in October. In our mind now, it's a matter of whether it's 25 or 50 basis points at the end of October. When you are flying blind, and the Fed is flying blind, especially now when they don't have their full complement of data, I think the tendency is to cut more. And no doubt there will be increasing calls to cut more, especially if the government shutdown extends into late October, which we think it will, given the parties that are involved in the negotiations, given what's at stake. We think this is going to go well into October and potentially even into November. It makes me wonder, could the big tariff surprise be that companies cut jobs instead of raising prices? Maybe so. Maybe that's the way it works out. In any case, we think the unemployment rate could be set to rise this fall from 4.3 to something higher than that. Not all the way to 5, but we think it could continue to rise in the fall. Now, these two twin bankruptcy filings in the month of September have caught our attention. Tricolor and First Brands. Tricolor is a subprime auto lender and dealer. First Brands is an auto parts company. But what, if any, is the message here? Both bankruptcies are related to the auto sector. The common thread, though, is collateral integrity problems at both companies. There are allegations of fraud here by both companies, or toward both companies. In both cases, collateral was pledged more than once. And when markets got wind of this, it undermined confidence dramatically and immediately. In both cases, there was a heavy reliance on private credit and non-bank financing, along with traditional bank financing. And we have to feel for both lenders if financial statements were not of high quality, so to speak. In both cases, there was an immediate loss of confidence, heading straight to insolvency. Tricolor didn't even bother going Chapter 11. They went straight to Chapter 7 and into liquidation. I think the macro backdrop mattered here. Relatively high interest rates for an extended period of time, the Fed being restrictive for an extended period of time, tariffs, unprecedentedly high tariffs, creeping higher, a weaker labor market, and finally, immigration control. Some of Tricolor's customers were leaving the country, no doubt. So all of these factored in here. And while neither bankruptcy was caused by macro alone, we think the environment itself exposed structural weaknesses in both companies. This is akin to what Warren Buffett calls, when the tide goes out, we see who is swimming naked. And these two companies were swimming naked. We see these bankruptcies as a potential distant early warning on the economy and credit. I don't necessarily think this is an indication that things are softening rapidly, but it's interesting to us that they hit at the same time in the same industry. And with credit spreads at all-time tights, we want to be vigilant here. There's a lot of complacency out there in the credit markets. Our digging has revealed that there will be private credit losses, especially relative to First Brands. We talked to a couple of managers this week that indicated that would be the case. And in some cases, it's going to wipe out a chunk of returns in the first half of the year for some of these private credit managers. So we reiterate our neutral rating on public credit and our overweight to private credit because we think things are intact here. We're not panicking as a result of this twin bankruptcy, but we are going to remain vigilant. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.